It has become the de facto reserve currency of the crypto world. It is the bridge between the chaotic world of crypto assets and the familiar stability of the dollar. When massive waves of capital flow into or out of the digital markets, that money almost always travels through the narrow channel of Tether first. Go to almost any cryptocurrency exchange in the world, and you'll find that USDT is one of the most common trading pairs. When traders want to buy Bitcoin, they aren't always buying it with US dollars. More often than not, they're buying it with USDT. It functions as the ultimate settlement layer for crypto trading, but its reach now extends far beyond the trading floors of digital exchanges. In countries where local currencies are collapsing from hyperinflation or where access to US dollars is restricted, USDT has become a financial lifeboat. For every single USDT token in existence, its parent company, Tether Limited, claims to hold $1 worth of assets in reserve. These aren't just piles of cash. The reserves are a mix of assets like actual cash, cash equivalents, and most importantly, short-term US Treasury bills. Essentially loans to the US government. The goal is simple and absolute: maintain a one-to-one peg with the dollar. If the market believes that every token is truly backed by a dollar in the vault, then the token will trade at a dollar. For Tether, stability isn't just a feature, it's the entire product. An individual can hold dollar-denominated assets in a simple crypto wallet on their phone, completely outside the control of a failing government or a broken banking system. They can send money to family across the globe in minutes for a fraction of the cost of a traditional remittance. For these users, USDT isn't a trading instrument, it's portable, programmable digital cash. It's a tool for survival. This meteoric rise has not been without a storm of controversy. Unlike Bitcoin, which is decentralized and whose issuance is governed by an open, verifiable algorithm, Tether is issued by a centralized company. Users have to trust that the company is managing its reserves properly. For years, regulators and critics have questioned this trust, investigating Tether's financial disclosures and raising doubts about the true composition of its reserves. This has sparked a fierce, ongoing debate about transparency and the systemic risk that a project this large could pose to the entire financial system. And yet, despite the scrutiny, Tether just kept growing. Its circulating supply exploded from a few billion to tens of billions and eventually surpassed $100 billion. At certain points, the company behind this digital token became one of the largest holders of short-term US government debt in the entire world. Think about that for a moment. A cryptocurrency project, a child of the blockchain, became a major creditor to the United States government. It represents a strange and powerful fusion of the old world of finance and the new. To maintain its dominance, Tether didn't stand still. It expanded, issuing USDT across multiple blockchains like Ethereum and Tron. This multi-chain strategy was clever. It allowed users to choose networks that were faster or cheaper, depending on their needs. By adapting and integrating itself into every corner of the crypto ecosystem, Tether built a defensive moat that competitors found nearly impossible to cross. Of course, the risks are still part of the equation. Because it's centralized, Tether can and does freeze addresses and comply with law enforcement directives. Because it relies on reserves, a crisis of confidence or poor financial management could still threaten its peg to the dollar. But day after day, the market votes with its feet. Trillions of dollars in volume flow through USDT, a clear signal that for most participants, its utility, its liquidity, and its raw convenience outweigh the perceived risks. When you zoom out, the bigger picture is clear. Tether represents the digitization of the world's reserve currency, the US dollar, placed onto programmable 24/7 financial rails. It gives decentralized finance applications a source of stable collateral. It gives traders the power of instant settlement. It allows businesses and individuals to move dollar value across the planet at the speed of the internet without waiting for a bank to open. Tether was never built for appreciation. It doesn't promise you a tenfold return. It promises something far more fundamental in a world of chaos: stability. And in a market defined by volatility, stability becomes a superpower. It's the liquidity, the bridge, the settlement layer, and the savings vehicle all in one. It doesn't compete with Bitcoin's vision of digital gold. Instead, it provides the stable measuring stick against which everything else is valued. The formula in the end was breathtakingly simple: maintain the peg, hold the reserves, provide the liquidity. and scale globally. That simplicity is what allowed a token designed never to rise above $1 to become one of the most influential forces in modern finance. And that is the enduring paradox of Tether. The asset that does not move in price is the one that keeps everything else moving. And that's the breakdown. If this clicked or helped things make sense, like the video, subscribe, and comment what we should break down next. We actually use your ideas to build future videos. Until next time, stay curious and keep learning.